A home equity reverse mortgage, or what we call a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are aged 62 years and older. It has some unique features that make it a valuable tool in retirement planning and aging in place. How can a HECM reverse mortgage help in bankruptcy, you may ask? Well, first, it can possibly help aging retirees avoid bankruptcy in the first place. But if they do suffer a bankruptcy, a HECM can offer easier solutions than a traditional forward mortgage. According to the Retirement Cafe, here are the top 5 reasons retirees might find themselves in bankruptcy. A HECM reverse mortgage does help reduce certain financial risks of getting older if managed properly. It can provide funding for long-term medical care or emergencies, supplement a loss of income, eliminate the necessity to service debt by using previously built-up equity in a person's home, and can allow an aging person the ability to age in place in the home they wish to stay in. Like any mortgage on your home, you must pay your annual property charges. So HECMs themselves are not risk-free and must be managed responsibly. As mentioned at the outset, one potential area where a HECM can help is where a borrower has had a past bankruptcy but wishes to buy a home or refinance an existing home or possibly cash out some equity to live on, depending on what the court permits him or her to do. In many circumstances, the use of a HECM is simpler than a forward mortgage due to the optional repayment. It may also be an easier loan to obtain compared to a traditional forward mortgage. Let's compare a HECM loan to traditional forward mortgage loan requirements after a Chapter 7 or a Chapter 13 bankruptcy. After a Chapter 7, unless you're buying a home with a HECM, there is no waiting period after a Chapter 7 discharge, unlike the forward world where the waiting period can vary from 2 to 4 years. Extenuating circumstances are those circumstances that allow you to argue that you don't have to wait the full period. In the forward world, extenuating circumstances are very well defined. However, with a regular HECM, there is no need for them. And with a HECM for purchase, you generally only have to explain the isolated circumstances that created the Chapter 7. With Chapter 13, with a HECM, unlike the forward mortgage, there is no waiting period after the discharge. Extenuating circumstances under Chapter 13 are more lenient with government loans, be they reverse or traditional forward loans, with 12 months of payments and the court's permission sufficing. In all cases, you have to show that you reestablished your credit. Unlike some forward loans, proving the reestablishment of good credit with a HECM is less arduous and quite a bit is left to the underwriter's discretion. Critically, with a HECM, there is no required minimum credit score. This does not mean that your credit behavior is not taken into account. It just means that there is no minimum score required. Also very important to understand is that the minimum requirements on a reverse loan as regards income, with its optional repayment features, are based on the Veteran Affairs minimum residual income tables, which can be a fraction of what is required with a traditional forward loan. Also very critical to note, as well, is that the borrower can choose not to make a payment and it has no impact on their credit report. So you can see with a simple comparison that a HECM can genuinely solve many of the issues facing a bankrupt or previously bankrupt borrower. Of course, it's not always useful or prudent for everyone, but it does have some very unique advantages. So what is a HECM? Well, it is a loan. It is debt. You do have to pay it back eventually. You may not have to make monthly mortgage repayments as with a traditional forward loan, but when you leave the home will have to be sold to pay back the debt if you don't have other resources. And like any homeowner, you do have to pay taxes and insurance. No, you don't sell your home to the lender. And yes, you can make a mortgage repayment if you want to. You just have the option of not doing so. And most importantly, your credit is not impacted. You will never owe more than the lower of the value of the home or the balance of the mortgage. This is a non-recourse loan. If there's equity left in the home, of course, it can be left to your heirs. The HECM has one unusual feature over a normal home equity line of credit, and that is that any unused balance, that is, if you don't draw down on the loan or any portion of the loan, it will actually grow monthly at the current interest and insurance rates. So how is a HECM different from conventional reverse mortgages, and what are some of its unique advantages and features? Well, the first is you have to understand that the property values under the program are limited to $636,150 or less if your property is worth less than this. However, if your property is worth $1 million, it's still worth $1 million. It's just that for the purpose of calculating the gross loan amount under this program, we will limit its appraisal amount to $636,150. Another feature of the program is a very important feature correcting what used to occur in the past. In the past, a non-borrowing spouse might have been evicted from the property if the borrowing spouse had passed or gone to a nursing home. This is no longer possible. Now the qualified non-borrowing spouse gets the same protection that a regular spouse gets. Also be aware that the funding on the whole program and all the lenders' performance is guaranteed by the U.S. government. While this might not seem like a very large advantage, in fact, if you think about living in your home for the next 30 to 40 years and having access to the money and knowing that the money is available to you, having the guarantee of the U.S. government is actually a very important aspect. It's not so much that the U.S. government guarantees it as they ensure the performance of the program. However, it amounts to the same thing. And also be aware that FHA lenders under the program are required to help with any temporary tax and insurance defaults. They will advance money to pay taxes and insurance and other property charges in the event that the borrower is unable to pay. The borrower, of course, does have to repay those sums, and if they don't repay them, they could face foreclosure. And while they're repaying those sums, they also have to stay current on the new taxes and insurance. However, it should be of some comfort to know that if you get into trouble, at least temporarily, the lender is required to help you. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.